Welcome to Money on Tap. Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. That's what we do on this show. We look at all sides of the issues, and we bring a fully independent planning perspective to the table.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. My name is Seth Krussman, and here again with Benjamin Brayshaw, Dan Mickelin. How you guys doing today?
I'm doing good, Seth. How are you doing?
Fired up.
Good way to be for the show.
Need to be that way. All our listeners need to be that way. Better be fired up.
Well, when we are delivering life-saving information, what other way can I be? The truth of it is that what we're going to talk about here on this show today may very well, maybe not save your life, but it could really save your retirement, and maybe that is saving your life. I don't know, but it's really important what we're going to be bringing to the table today. We're going to be talking about the recession is not the market. Can you believe that?
I can.
I can and I do.
Oh, is there some buy-in? Do we need to just rewind here for a second and say, folks, what are we going to do today? We're going to show up and we're going to talk about the market is not the recession. And it's the truth. I cannot wait to really dive into and pull this apart with you guys.
I mean, just because the Fed is raising rates and all this stuff's going on and everyone's scared, and then you got this, inflationary event going on. Everyone's just running scared from lots of different things. For some things are founded and some things are just unfounded. And I think kind of getting to the bottom of, which one of those is where some of our listeners are at and getting some real good grounding on that, I think is going to be, a solid opportunity for people to get some clarity.
Yeah, I mean the market's emotional, right? So when you hear about recession and raising rates and kind of all this bad news, it can tend to trigger sell-off, which we've seen happen. But it doesn't matter. It doesn't mean that these companies don't have value. It doesn't mean that they're not still making money. So there's some underlying strength there that you certainly want to be wise and be a little bit more selective, but even if we do slip into a recession, even if we don't find that soft landing, that does not mean that the market's just absolutely going to tank.
I think it's really funny that, people sell their stocks and go to cash, which is the worst recessionary, inflationary asset in the world.
Yeah.
And don't hold on to the big Procter & Gamble, Exxon, Chevron assets that produce a yield that their revenues grow because they're dealing with the inflation and charging people more. Like that kind of world, like getting into something that is moving with inflation is significantly better than something that is stagnant and deflating every day. I think it's funny that that's people's thinking.
And that's the emotional aspect to it. People tend to do things with their money out of, two driving factors, right? It's fear and greed, and to get the situation here where fear is taken over and, it just leads to these sell-offs, these big downturns. But, some of these companies are getting into a spot where they're just really well priced.
Yeah, I look at this stuff and just say, man, it looks cheap. I mean, we're looking at numbers in the market that are below, pre-pandemic.
Yeah.
And it's, people were looking to engage there long ago.
Absolutely.
And the other thing to remember is that for every buy and sell, someone owns that stock at some significantly higher price that's waiting for it to come back.
Yeah.
No matter who it is.
Well, there's the show, folks. So stick around. We'll have part two here in a minute. But before we do, we are going to take a quick break here for Money in the News.
All right, first article up here is from Benzinga.com. This is from Shivdeep Diwali. And this one just caught my attention this morning here. Elon Musk says he doesn't care about boosting Tesla stock with Optimus Bot, and the economic implications are obvious. Now, this I found to be interesting because, well, number one, it's Musk, so we like to, pay attention to him, and he seems to make the show almost every week. But, he is a CEO unlike most, to say it in the most polite and, minimalist way I can say it. And his use of Twitter has gotten him in trouble in the past on a couple different levels, with the SEC and, led to some real issues. But it was just mind blowing to see this, right? So, I mean, we know he's a different guy. He's an inventor. He's an entrepreneur. He does lots of things. But he's kind of missing the point here a little bit from a publicly traded company perspective. The CEO is supposed to do things based upon the interest of the stockholder, right? And here he is in public telling everybody, the world to see on Twitter, that he doesn't care about stock price. So it's just kind of an unbelievable thing to hear from a CEO. And I didn't even know what this Optimus was. I had to secondarily look that up and get a handle on what he's actually doing here. But Tesla is rolling out these AI-based robots for, I guess, personal and home use and all different kinds of implications as to where there's value in that, down the road for the shareholder. But to come out and to say it as boldly as he did right now, nobody Tesla's down 9% to start the day too. So I mean, he had an effect. Yeah.
Well, I mean, that's the thing, Rick. Any other CEO that would say that, the stock would be down 50%, right?
Yeah, fired immediately.
Yeah, I mean, that's their whole. I mean, they represent. I mean, it's that's laughing. They represent us owners of the stock. We're an owner with him. So you're telling me that you don't care, but I do because I'm investing in this company.
Not to mention most CEOs own tons and tons and tons of stock in the company that they're the CEO of, right? So it's a big effect on his wallet, not to mention his job and his responsibilities and the board of directors and all that.
Yeah, it's just kind of interesting that he goes through that process. Whatever. I mean, he's half brilliant and half stupid. I mean, at the end of the day, the robot will probably be great, and he's probably like, well, I don't really care about the stock. I'm just working on my next project. I think that's really what he's saying. He just doesn't communicate well.
I think it's really just a bit of him having fun with some reverse psychology as well. And I really just jump on the bandwagon there with what Ben just said. It's like, you know what, guys, the stock's going to go up, right? He's confident. Right now, he's not too worried about it. What he's really focused on is his projects. And if without that kind of without that kind of laser focus and intentionality around what it is he's doing, the stock price doesn't really matter in the end of the day, because
the stock market has too much crap going on inside of it that you need a double negative inside of it with the CEO talking.
Totally.
Everyone's speculating way too much anyways.
It was an ultimate confidence move.
The guy is something. You got to give him that. But one thing, it also got me thinking about, and we were just talking about this, is before you make a major investment in any company, you might want to check out the CEO and
mental stability.
Make sure that they have their priorities in order and understand what it's all about as an investor. But, I mean, I think you're right, Seth. I think half of the stuff he does and says is just for the reaction of it. He likes just poking the bear and having a little fun with it along the way. But he'll probably get sued by the SEC for $100 million for that or something like that.
All right. Next up, we've got from Yahoo Finance, we have painful signs emerge that Fed is moving too far, too fast with aggressive rate increases by Michael Hiltzik. Wow, what an article. I was, we have talked about the Fed raising rates a number of times on here, and there's a number of countries that are actually lowering rates. I mean, I think Turkey's one, China's one. There's a few of them out there. The fact that, there's so many other countries that are raising rates and dealing with monetary policy in a number of different ways. You've got the Bank of England, European Central Bank, Bank of Canada. They've all raised those rates in unison, as this article points out, with the Fed. But there's just a lot of speculation. It's going from, hey, vast majority think we need to raise rates, to people are getting very, very nervous. You got three, major rate increases all at once. We're seeing downturn, and no one knows how the world is going to embrace this financially. And with this quick turnaround in such a short period of time, and the fact that we are seeing really ample numbers of movement in the right direction, according to what the Fed is declaring, they're also talking about and inferring that the rates are going to continue to rise one or two more times in a significant manner to really get this thing under wraps. The problem I see with that is we haven't seen anything like this since the 80s. And the real problem is this is not speaking to the soft landing potentially that they keep declaring they want to have. I mean, you can't, 0.75 of a point is an astronomical increase. We've over doubled our 30-year rate, on a home mortgage in less than a year now. because we're over a 7%. I saw 7% 30-year fixed. That's incredible. And it's just very, very scary when you really start looking at that and trying to comprehend how that's going to happen. Because in reality, right, if people aren't building homes, who are the first people affected? The electrician, the plumbers, the contractor.
Yeah, I saw a stat in here, I believe it was in this article too, about home build starts have dropped dramatically. I think they'd fallen off like 16% or so in the first quarter. So, that effect of, just that the single indicator in the mortgage rate, obviously it's an important one, but that's one of the ones that's going to have the quickest, widest impact throughout our economy, right?
And it's the people who, need this pain the least, probably.
Yeah, and then those are the people who, there has been some acknowledgement by Powell that, all the tactics that they're taking here to kind of curtail inflation, there's going to be some pain out there for people. And what that points to is people who are just starting out in careers, the lower end of the income ladder. These are the people who feel the pinch the most and who have suffered the most from the high prices along the way. But when they do take these steps, which are specifically eyed towards, causing some cooling off in the labor market, layoffs. I mean, they're going to trim jobs, and those are going to be the people first get cut.
The quote that actually came out this summer was the Treasury Secretary Lawrence Summers, who told the London audience that we need 5 years of unemployment above 5% to contain inflation. In other words, this is direct as we need 2 years of 7.5% unemployment, or 5 years of 6% unemployment, or 1 year of 10% unemployment. So, he's not necessarily saying it has to be done one specific way or another. However, unemployment is one of the things that he's saying has to happen in order for this inflation to be staved off. And the tool they're using right now with the rates is just, they're not compromising one bit on the direction that they're going here.
Well, for our listeners, Seth, I mean, those numbers are astronomical, but our listeners probably don't even have the entire perspective on that. But unemployment in August was only 3.7%.
I did miss that one, yeah.
Well, I mean, it's just like, you think to just get to 5% and to keep that, or 7.5% for 2 years. I mean, that's doubling our unemployment. I mean, it's such a huge number, and trying to deal with that and work through it. I mean, people who are unemployed are not making money. Their families are struggling and they're suffering, and we're like trying to mitigate this stuff. And do you want to struggle by paying more at the pump, more at the store? All these things can be mitigated in other capacities too. But the truth is like, do you want to watch somebody who can't get a job who wants to work? Because unemployment are people who really do want to work.
And what the article points to as well, and then there's some specific measures in here, is that when the Fed makes a move like this and they increase rates, the real impact that each one of those increases has had isn't immediately apparent, in the economy and really in most of the numbers that we use to measure this stuff. So it just takes a little bit of time for that change to take effect in a meaningful way and work down inflation. And we've seen inflation, certainly it rose rapidly. It wasn't transitory, so they were wrong on a couple different bases. But it did kind of level off in the late summer. And, some prices they've gotten a little bit more control over them. Not everything, of course, and stuff is still high, but it's not increasing like it was. So there's at least some indication there that some of these moves have had the desired effect, but then they keep just throwing the increases at it. Why don't we just take a little break and let's just let this thing cool off and truly see where we are. Let's get a better gauge on the current state before we keep applying these rate increases.
Yeah, and I think when you really look at, I was thinking about, it says the current trend of increase, I'm quoting the article here, the current trend of increases in interest rates is the fastest since 1983. And when you really think about that, I think about back in the 80s, I remember, all of construction and home builders, people are losing their homes. Contractors are losing everything. I remember I had family and friends that, even as a kid, remember them struggling and selling, toys and, car, like they might have had a nice car or something like that, trading that in and getting like a beater, people were really, really struggling back in the 80s. And I think unless you grew up during that time, do you remember people suffering? That's scary. It's really, really scary that we might have a even worse than a repeat of the 80s. So it brings us back to kind of the concept of our show. Inflation isn't necessarily the market, but there's a lot of things out there that people will buy every day, and they will buy toothpaste. They will buy, shampoo. They will buy a lot of these things. There will be gas sold. Whether or not someone's buying a robot that, Elon Musk is making, that's probably an optional purchase. And I think, when you really get down to what's a necessity and what really drives the world in an inflationary environment, that's a big piece to consider inside that.
Yeah, for sure. We're going to continue to keep an eye on what the Fed's going to do here, and hopefully there's enough continued news like this to put a little pressure on them and maybe stave off one or two of these increases they get scheduled. But all indications made publicly anyway so far are that they intend to charge ahead with this thing.
Well, monetary policy always all the information lags behind it, right? So they make this policy and then they wait for something to happen, and they're still making policy and stuff is still trickling down, and it takes a while. So the fact that they show no insinuation that they're even looking to, hey, let's take a breather for a second. We just made some astronomical increases, and we need to give ourselves a little more time to bring more data in. That doesn't seem to be part of the conversation.
And we did a show a while ago on this and how they measure this, and it's year over year, right? So they look from July to July, August to August, September to September, et cetera. So those numbers where things were spiking, they stay in that math until they become more than a year old.
Right.
Even though it's got little to do with what's actually happening
today
in the present.
Right.
So these averages get inflated by the huge numbers, in the early parts of the 12-month calculation. But, give it a couple months, let some of these big numbers fall off, and we might be looking at a totally different picture.
Right. Agreed.
Well, folks, we cannot wait to get into the topic today. We're going to be talking about the recession is not the market. We just were, visiting a little bit around the Fed and what they're doing and trying to tighten up our money situation with inflation, right? And how are those numbers going to reflect back into our economy, and what are some of the policies that they have in place that they're continuing to, raise rates. And you know what? All that stuff right there, it's not the market. It just isn't. And so it's going to be fun to actually jump ship here, and we're going to be talking about that. Don't go anywhere. We will be right back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com.
Do you have an annuity? Do you understand exactly how it works and when to use it? The likelihood is that you don't, or maybe you bought it a while ago because at the time it sounded like a good idea. But will it accomplish your goals? We are here to help you. Contact us about a free annuity review and learn what your annuity does, how it works, and how it can best help you with your retirement goals. It's absolutely free to you, and if there's a better way for you to accomplish your goals, this is a great way for you to learn about those opportunities too. Take the time to get educated, get empowered, make your retirement a success. Call us at 855-226-8551 or info@yourmoneyontap.com.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, today we are bringing to you, the recession is not the market. So we're going to be really talking a lot about the correlation in recession and market, but to try to lay some groundwork here, what is a recession? I mean, how many people right now could pull out of their pocket and say, well, it's this, it's that? I mean, most of us kind of take a look and say jobless claims are up, right? We see, the price of oil at the gas station. Maybe that's what your definition of a recession is. But to get us some groundwork for where we're coming from here, Dan, do you want to lead us off?
Yeah, I mean, the true definition of it is 2 consecutive quarters of contracted GDP, right? So that's the indicator that the economists look to, which we've experienced. I mean, we're in that now. We've just gone through 2 consecutive quarters of contracting GDP. But we're not officially, quote unquote, in a recession until it gets declared by this group of 8 economists, which is the National Bureau of Economic Research Business Cycle Dating Committee, which is a whole mouthful of, I don't even know who these guys are.
There's 8 crystal balls sitting somewhere in this world that they go, oh, we're looking at a recession.
Yeah.
But they're a dating committee. That's interesting.
So, they'll let us know when we're in a recession, apparently. Otherwise, every other indicator and everything you hear in the news and everything we experience when we go out the shop would tell us, that we're in it right now, that's already begun.
I think when people start hearing the word recession, they get scared. There's a lot of fear out there in the conversation of, hey, the Fed's raising rates. People are, we talked about it, home construction, loans, activity, all of that stuff is dropping off the table. I mean, we're seeing those numbers get hit hard. And so that's usually where the first piece of, recessionary data comes from, is the expenditures of people who are in the trades. Honestly, I mean, it's the majority of our workforce at times. So there's some real concern about that. And a lot of people are looking at their 401ks and they're experiencing massive, downturns. They look at the S&P 500, which is, it doesn't fully represent the stock market. The S&P 500 is, 505, large U.S. companies that, we base good, bad, and ugly on. I mean, the Dow Jones is what most people look at, and that's only 30 U.S. companies. Yeah. So it's like, you could turn around and say, oh, the Dow is down, the S&P is down, but if you weren't invested in any of those things, you might not be down. So that's complicated, and it's difficult for a lot of people to really get their hands around it. And then we've talked about in other shows that when a lot of investors buy the S&P 500, it's not like they own the 505 stocks in equal form, right? We've talked about that. Like the top 10 holdings are usually anywhere from 25 to 50% of the entire investment of the S&P 500. And it's Apple, it's Microsoft, it's Google, those are the majority of the holdings. So when we really see the bath, like Apple's taken this, 20+% bath over the last few months, people are seeing that in their S&P holdings, and yet not every company in the S&P is suffering as bad either.
No, I mean, that's a really important point because, for all kinds of reasons, we look to these indicators, right? And the S&P 500 is a really easy one to look at if you're trying to gauge the health of the stock market. But it is so disproportionately weighted in a handful of tech companies that, you think the whole entire economy is crashing around you. But, honestly, it's technology companies that have suffered the worst. There are actually sectors out there that are doing well, okay, or certainly not suffering as bad. So there is always opportunity that exists. And when you're looking at, these S&P or the Dow or any of these major market indexes, just keep in mind, I mean, it's not to say that there isn't bad news out there, but they are disproportionately weighted into a smaller handful of companies. I mean, not every one of those 505 companies has an equal effect by any means. It's vastly different on the index itself.
One of the bits of advice that we hear a lot of is the question we ask is, how do you stay invested? Because what we know around investor behavior is when the market pulls back, investors will usually pull their money out. There's fear. And that makes sense. You don't want to lose any more. But what happens on the other side of that is that the money isn't in the market when the opportunity is there to come back. So there's, a bit of the loss is exacerbated through that process is what happens. So one of the things we want to ask is how can we help here to try to maybe alleviate some of the tension there, alleviate some of the fear, and really puts you in the best position possible, regardless of recession or no recession, to stay invested and be an investor for the long term. And long-term investing has given us numbers over time that when we talk about those numbers with you and with our clients, those are the numbers that people pay attention to. Those are the ones that people want to participate in. What is the market average return been? Well, the market over corridors or periods of time has done quite well. And if people want to be involved in that, well, then they need to be prepared to just kind of sit tight as well. But there's some things that we can do. There are sectors of the market like technology, for instance, because we have a rising rate scenario, that is not done very well. And that has also been a huge part of that S&P 500 story. So pulling it apart, where can people go? What can people do to still be invested and maybe not necessarily experience the same ride that, the full boat of your S&P 500 or your index investors are out there?
Yeah, that's important, and we're going to touch on that, here in the show. Is some opportunities are still there to find some safe haven and still participate. But we had a meeting this morning, Ben, and the point you brought up was great. Some people think of, well, as I'm planning for retirement, I'm invested in the 401k, but on the day I retire, I exit the market and just spend down and go straight to cash. And that's not at all what happens, right? So you're going to be retired for 20, 30 years. So it's important to, be wise with that money because we need to find a way to stretch it, but realize that there will still be market cycles over that period of time. There'll be ups, there'll be downs. The best way to get back to where you were and reach new heights is to not try and time it, but, be prepared for these things to happen and understand it's a natural course of the market, but stay the course, find a way to continue to be invested. You don't lose all of that downturn until you truly exit.
Yeah, and I think as you're looking at retirement yourself and you're kind of working through those thoughts and in reference to what you're talking about, Dan, retirement is not a light switch. It's not, hey, I'm retiring tomorrow. Here, I'm going to turn on my retirement plan. Investing is an in motion kind of event. It's something that you're managing through that process and trying to make that retirement experience not a cliff of change where you're falling off the cliff and figuring out how do I get retired now. And people usually have their own idea. It's not always the right one. It's not always one that works, but they have an idea. I've always found that to be the case. I think, when we're talking about recessions, it is the hardest thing to do is when the first 5 years of retirement occur and you're actually in a downward market, it amplifies your lack of success in retiring. I think it's like tenfold. It's incredible how the first few years is actually the driver of how well your retirement will do. And so for those who are retiring, and there's a lot of them, recession is a big, big fear. And if you know those statistics, it's probably even a bigger fear, and you're listening to us today. During, post-World War II recessions, the S&P 500 declined around 29%. The median decline was around 24%. And
that's on average for each recession.
Yeah, for each recession. And so when you start looking at that, you start getting really fearful. And I think, Dan, when we were talking about this, I think your point was really well made. Is that at the declaration that there is a recession by the 8 crystal ball guys that get to figure that out? Or is that total? And we don't know which one we're at, but we're basically somewhere around that 18 to 20% range. And we could see another 10%, maybe 5%, drop inside this space pretty easily. But, if we're looking at another 30% drop, that's the real fear that a lot of people, don't know how to, to address. And I think we're going to really kind of cover that and get people into a space that whether it's the first item or the latter item that I described of how this actually all plays out, there are ways to address that today to get yourself in a better spot.
And just to kind of further that point there, the worst of the recessions that we've experienced had a total drop of about 55%, right? So that's significant. And that was a prolonged recession, but from all the forecasts that we see, and who knows, maybe these are other crystal ball guys. There's a lot of crystal ball guys out there apparently, but the most common thing that I've read is that we are headed to recession. I personally believe we're already in it,
Yeah.
right? And there's a lot of data to support that, but that it will be mild and short. Is you hear that often, that it's not going to be they're all catastrophic, but this isn't going to be one of the worst of all time. And there's one that we can point to in our history, that recent history, that had similar causations, and it has, seemingly a lot to do with where we're at in performance at this point. But in the early 90s, there was a recession that was, basically attributed to two things. It was monetary policy, right? Tightening of the monetary policy, which here we are, Fed's raising rates all the time now. And there was a spike in oil prices because we invaded Kuwait, the Iraq war. And that's another thing that we're experiencing right now is tightening in the energy market due to a war. Now that recession, actually during the declared recession period, right? So from the day in which it was declared by this committee and the day they told us it ended, the market was actually positive. The S&P was up 4.3%, and the NASDAQ similarly 4.38%. But from the peak of the S&P prior to that, the drop was about 21.5%, and the NASDAQ fell about 32.5%, which those are levels we've already attained. We're already there off of these indexes. So, it's a little bit complicated, but understand that, by the time they tell us we're in a recession, we could have already been in there for as much as 6 months, right? So there's 2 quarters potential lag on there. And when they tell us that we're out of the recession, we may have already been recovered for 6 months as well because of that. These definitions and these declarations are based on lagging quarterly GDP numbers.
Folks, you're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're talking about the recession is not the market. We're going to take a quick break and we'll be right back.
For a number of our listeners, they have a lot of questions, and you might be one of them. Today, we're just offering what we call Zoominars, webinars over Zoom meeting rooms, where we have top experts, Social Security, estate planning, and financial planning experts for you to speak with, do a private consultation that way today. We're also having webinar-based Zoominars where we're going to have multiple groups where you can be part of that and enjoy that as well. Give us a call at 855-226-8551 or email us at info@yourmoneyontap.com to schedule your Zoominar.
We appreciate you listening to Money on Tap with Ben, Seth, and Dan. You can contact us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more of this week's program.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We are talking about the market, or the recession is not the market. And Dan, where you left off there is one of the things I really enjoy about, the ability to have a conversation around a topic like this. Yes, there's a challenge in the market right now. Take a look at the numbers. Take a look at all the things that you lined up around the recession. 2 quarters GDP have dropped. The market is down. There's a war. It's not necessarily around oil, but my gosh,
It's around natural
Russia.
gas to.
Yeah, natural.
Europe is very dependent, right?
Seems like it's more about
energy
wheat,
and
but-
resource, right?
Yeah. But it's happening. All those factors are really there and baked in. But, those are the things that you're going to get in your headlines every day. Look at your phone. Look at whatever you want to look at. You're going to hear about these things going on. What you don't hear about necessarily is what the other side of that is that, a bounce back from a recession. The S&P is, typically bounced back sharply after every recession that we've had. And it usually has began that major rebound well before what they title as the end of this recession or quote unquote. And one of the things that's really fascinating about the study of the market around this is how The market is one of those great predictors, right? We call it pricing into the market. A lot of the time when the market is moved, it's already priced in whatever the Fed has come out with and talked about. You know, we've seen the Fed make an announcement on rate changes, and well, guess what? We already had that priced in a week ago or longer ago, and maybe it doesn't even move. And so it's really interesting to see how where we're at right now could very well be the bottom based off the numbers that we see on the averages. We're pretty darn close, if not. And the potential there to, you know, for those that have stayed invested to see a pretty significant return on that commitment. And I call it that, a commitment. Folks, if you are in a retirement corridor, you've got to be committed. You know, you don't just bounce out of the market because, you know, stuff is going on, right? I mean, maybe stuff in your life is going on, like you got to buy a piece of real estate or whatever you got to do, right? But whatever's going on in the world, this is not necessarily where long-term investors will back out. And those are the people that are making the majority of the money off of the market, is the people that stay invested for the long term.
You know, I was thinking about, Dan, what you were talking about. You know, it hasn't been a declared recession. And, you know, I'm probably more of a conspiracy theorist than the average Joe, but, you know, I mean, we're staring at an election right down the barrel right now. You know, midterm elections are looking at us, and we're staring, and there is no benefit to the current administration to declare there's a recession, right? And I think, you know, that's kind of the one thing that's holding us back, because we have the data points that point to a recession, but we aren't having that declaration. And why would you want to? Why would you want to add bad news to your current administration in the middle of a midterm? And so I do believe we are in a recession. I do believe that it has been a forced recession. And I am very nervous about the Fed and continuing to raise rates with some of the obvious dramatic changes that we've seen in the economy around us, and the fact that they seem, you know, still full steam ahead. So that, you know, that leaves me with some real remarkable questions, you know, and I think that's important for people to realize that, you know, you have to really look at what's going on around you and say, hey, is this really where we're at? And if that's the case, irrelevant of what people are saying it is, if we're experiencing it, maybe that's the time to really evaluate how my investments are, so that I'm not staring the gun down the barrel either, walking into retirement.
Yeah, I mean, it's really fundamental to the title of the show, right? The recession is not a recession is not the market. You know, just by kind of definition from understanding what they are, a recession is measured backward looking, right? Investing in the market is about speculation. It's forward looking, right? So you have these two perspectives that aren't a lot aligned at all, and you just have to, you know, understand that as you look at these things and read the headlines you were talking about, Seth, and you look at your portfolio and you say, well, you know, where are we today? Are we in the recession? I think we're in agreement that the answer is yes. You know, has the market taken all the fall it's going to take? Well, you know, we can't tell you that, but we're in the range of what an average recession does, right? So from this point looking forward, you know, what does that mean to you? Does that you know, is fear taking over, where you're saying I just can't afford to lose any more, or are you more of the mindset saying, well, hey, listen, opportunity's just been created. You know, there's going to be some upside to this thing, and maybe it's a time to either get further invested or potentially just remain invested in a safer way, in a different way.
You know, there's just so much to this, honestly, as I kind of walk through it in my head. I mean, when we look at the different recessions that we've stared at, and you mentioned, Dan, that, you know, 55% was the bottom of the worst one, and we have in. I mean, 2008 was horrendous. That was in the 40% range. And so, you know, are we there? I think that's the piece that people are asking. Are we at the near bottom? Should I be investing right now? Should I continue putting money in, or I have money saved and I'm thinking about how do I amplify that? Well, I think as we switch to, you know, how to invest for a recession, I think you have to ask yourself, you know, where real value is. You know, where is, you know, the next opportunity to find? I mean, we look at the numbers in the market. I mean, things are all below the 2020, you know, pre-pandemic scenario. So if you like the world before 2020 and the pandemic, you should really potentially like it now. And there's a lot of things that I would say are significantly on sale. There's a lot of investments that I think offer long-term opportunity and that, offer some significant, strength around a recessionary play. I think that the last place you should really probably be is in the bank, unless you really think we're going to collapse. This is the time to mitigate inflation and buy potentially, recessionary friendly investments. And I say friendly because nothing's guaranteed against loss in the stock market. That's the big piece. For a lot of people, there's a lot of different types of ways that they invest. They buy stocks or they buy culminations of stocks, which could be ETFs or mutual funds, which means that there's a play in multiple areas. We have talked repetitively, for at least a year or longer, or maybe 3 or 4 years, about high yield value stocks. Till we're blue in the face, right? Guys, right? We have not just absolutely belabored the point of that. And, there was an article in Kiplinger that just talks about some of these very, very strong recessionary proof kind of plays that also have, specific areas like healthcare. Healthcare was one. And I think for people who don't really know where to go or how to get there, and choosing the right healthcare stock or this, that, or the other thing, you could really just look at an ETF in a healthcare space and say, I think healthcare might be my play. If that's what you're thinking, you can really get the diversification there through to ETF strategy. But as I was reading that article, Dan, Seth, I was just laughing because some of these stocks that they were actually even talking about, and I just think it's funny to just even mention Netflix. It's down 2/3 its value in a year. And I know they have competitors. I know that everyone's in that space, right? But it's PE 17. There's incredible things that are on sale. Now, how good the sale is, I don't know, but I really do think that Netflix is a player for the long term.
You just have to think about it, I think, in these terms, and this is something that, doesn't go over anybody's head. Very simple stuff, right? Yeah. Even in a recession, even when money's tight, what are you going to continue to buy? Right? You're going to buy toilet paper and toothpaste and consumer staples, right? You're going to eat, so you're going to buy food. If you have a health event going on, you're going to go be seen by a doctor. You're going to carry your health insurance. If you're, I think most of us have gotten to the point, this might be not as core as those other things, but you're going to keep your Netflix subscription.
Yeah, I know.
You're going to keep your iPhone.
It's not a high yield stock, and I'm not recommending it, but I'm just saying there's some significant sales here going on.
Yeah, you nailed it right there. How are you? Because you already are. You're buying this market. You just don't see yourself going to the trade desk and putting in the ticket, right, and getting that punched and walking home with shares or something. But you are right now, whether you realize it or not, buying the market. And how you're buying the market and everyone else is buying the market is probably one of those great mindset tools that we could, advocate for, investing throughout these periods. Like, for instance, the healthcare that you mentioned, it's right now they are hiring. There's a pullback in the economy, but there is not a pullback in that sector. And we talk about these in different sectors or segments of our economy. Energy is another one of those that's been historically across the board. Look back at every recession that we've pretty much gone through, and there has not been a pullback in those energy in that energy sector. It's been an outperformer. So why is that? We can say this and you can still look at it and say, well, that's not where I feel comfortable or safe. And that's not the point. We're not trying to tell you to feel comfortable and safe in the market. That's not the market doesn't really give you warm fuzzies anyways, folks. Let's just face it. It's trauma. If you want to look at it, it's trauma if you want to look at the market on a daily basis and just involve yourself in it. But these sectors can definitely be understood a little differently because they are the things that you need, the things that you are not going to be without. And one of the things that was very interesting when we went through the 2020 cycle of the market, which that was dramatic and drastic, and it was the COVID inflection in the market. What was it that everybody was doing? It was the stay home story, right? Everybody stay home. Well, we had a lot of tech that just went through the roof during that period because it was what everybody needed to stay in front of life, in front of the game. Everybody, grandkids, grandparents, everybody was on Zoom, right? Household name now. Before that, nobody knew. Hardly anybody knew about Zoom unless you were just, like us doing this today, using Zoom. But this is a different story today, right? Because we're now kind of out of that. People are going back to work, and people are now doing traveling and doing these different things differently. Maybe some of the places that you want to consider are some of those travel places because, the difference between the euro and the dollar with that strong dollar has been a big story as well. More people are traveling overseas. But this is what we're coming back to is we're trying to figure out, what are the things that people are going to continue to need and use on a daily basis?
That's a great point, Seth. And I think when you really start breaking down all the different pieces of necessity and what the world is basically trying to figure out how am I going to survive in this inflationary? And when the person does cancel their Netflix subscription, Dan, you've hit a really rock bottom, right? I mean, Disney Plus is going first for me, like I'm still keeping Netflix. So those are different things that are really interesting conversations.
Folks, you're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. We're going to take a quick break and we'll be right back. More on The Recession is Not the Market.
If you're listening today and, your questions are outside the box of estate planning or financial planning or any number of the pieces that we kind of traditionally talk about, don't forget that Brayshaw Financial offers auto, home, and business insurance. And we have an entire department that handles all of that for you. Give us a call at 855-226-8551 and be happy to take care of those needs for you. Or email us at info@yourmoneyontap.com.
You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. And now, more Money on Tap with Ben, Seth, and Dan.
Welcome back. You're listening to Money on Tap. You can reach us at 855-226-8551 or info@yourmoneyontap.com. Folks, want to just say thank you for listening today. We're getting close to the wrap on the show. We're going to be talking more about the income side of things here because that's really one of the main places where retirees have to focus and the sustainability of income.
As we talk about kind of the overall risk, because no one knows, we don't have the crystal ball. No one gave us one. We're not one of the 8 people on the recessionary thing from the article. But, we do know that, there's some bleeding that's happening in the streets of the market, and we don't know where that ends. I think for a lot of people, they're concerned about whether or not we've already taken or absorbed 20% of that kind of historical average of like 24 to 29% loss, Dan and Seth. As you're listening to me talk about this, folks, do you have another 10% that you can afford to lose in your portfolio? That's really the question. And then the bigger question is, once they declare a recession, which is coming, is it 29% from there? Are we looking at another 2008? Are we looking at another 20% bloodbath in the streets? Is that really a possibility that's in front of us? That we don't know. What we do know is there are things you can do. And for people who are feeling vulnerable or feeling lost or feeling kind of unsettled about that, which trajectory are we on? Are we going to go down a little bit more or a lot more? Or are we at the bottom going up? I think the latter of those is the most hopeful and probably not the most realistic. That being said, there are ways for you to make lateral shifts. We've talked about income, we've talked about annuities, we've talked about value stocks, we've talked about all those things. There's ways to get lateral shifts into the annuity space, for example, where you can get full market exposure, okay, and lock in a pension income today, now at where you're at. And if the market's great and golden and wonderful, well, you're going to experience a portion of that recovery, a significant portion, if not almost all of it. That being said, if the market goes down at least you have ensured your ability to retire off of the income that you're going to be deriving from your retirement funds anyways.
Yeah, I mean, what may or not have been understood there or not, but if you have money that's in the market, you're of the opinion that you can't stomach any further loss, but you'd like to participate in the recovery should it happen. We have tools that are typically annuity based, where your lifetime projected income at a minimum would be based upon what you put in as your initial investment, your initial premium. So even if the market were to further tank from here, your projected income would not. It'll be locked in based upon that initial investment. And there are some types of products out there that will actually protect you either against, some degree of further loss. They'll refund it to you up to 10%. Some products even offer 20%. And some products offer you no opportunity to lose from here, period. They've locked in a floor level based upon where the index stands today. But with all of those, there's give and there's take, and some of your upside gets limited based upon how much downside protection you're looking for. But with the one thing that's generally true about all of them is that your projected retirement income will be locked in and be based upon that initial investment that you make. And the longer that you stay in the product, the better that income will become because of the simple fact that you're aging before you begin it.
Right. And I think the thing is for a lot of people who are concerned about lifetime income and entering retirement, I would tell them to go to, our website and look at, the sequence of returns video under resources. Just go watch that video. It is literally the exact story that we're talking about today. And if you just retired a year or two ago and you're saying to yourself, we're losing money hand over fist, it might be time for you to shore up, the dam of water just flowing out, of money flowing out of your portfolios in this market, just to create some substance of protection, security, all of those different pieces that people are afraid of. And as I kind of conclude that thought, there's just, people sometimes think when they're investing in like an annuity or going to a blue chip value portfolio or looking at doing it, they feel like they're giving up. There's kind of a thing like, hey, listen, I've been managing this market for all these years. No, you're transitioning. You're not giving up. You're transitioning. And you're transitioning to a healthy retirement perspective kind of portfolio that really can take care of you or your spouse. And you can get joint lifetime income, single lifetime income. There's so many different options. Why you haven't made that step yet today, I don't know. But that's something you should be considering, looking at, and shoring up another 20 or 30% loss in the market, if that's what you're staring at.
Yeah. If you are an investor out there in real estate and you have multiple holdings and you're still out there doing all the work, all the drywall repairs, pulling all your own carpet and changing all your own toilets, eventually you get to a place where it's like, it's time to kind of hand some of this stuff off, right? Or change, roll it out and roll it into something else, because that's just the way the investments work. That's the way that life works. And I love how you put it there, Ben. One of the other things I was really noticing here is in terms of diversification, because everything that you read out there is eventually going to come back to the idea of diversification. And what is that? It's a 70-30 portfolio. It's a 60-40 portfolio. It's stocks, it's bonds, it's blend. Well, what we're talking about in three-dimensional investing here, folks, it's where we're at. So we talk about in Money on Tap all the time. We take a look at all sides of investing. That is diversification. What do you have for lifetime income? You don't have that? You do not have diversification in your retirement. You have not checked all the boxes. So it's a mindset. It's an understanding, and again, it's the relationship that you have with your finances and your investments, and the partnership that we have here with you. We thank you so much for joining us at Money on Tap and listening today. If there's something that has triggered in you a question, and we just didn't answer it, we just maybe didn't have time to get down to it, give us a call. That's what we're here for. Call us at 855-226-8551 or info@yourmoneyontap.com. Schedule your free consultation. We will take the time to go through, what do you have under the hood? Do you already have annuities that are, past due and really done the job that they were supposed to, and maybe there's something else that you need to take a look at? Or are you just purely in the market and have, really need to take another look at creating a solid, stable income for yourself in retirement. Looking forward to sitting down with you. Looking forward to discovering those opportunities with you folks. Make it a great week.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.
Well, bye.